Hey, welcome back. My guest in this segment, actually he's not technically a guest anymore, he's kind of part of the home team. Dmitry Zaytsev is our in-house resident analyst and chief, I'm going to call you a millennial, I hope you don't mind. Chief Millennial. He's our millennial in chief. And today, Dmitry's going to walk us through some of the thinking that he employs in his construction of investment strategies, which have been uniformly successful. I can say that with full conviction because I've been following what he's been saying to me, and it turns out that he's right more often than he's wrong. One of the critical elements of success in any investment program. So Dmitry, welcome back.
Glad to be here.
So let's start with your first slide. You've got technicals here on weed.
So this is just something, this is just from my brokerage, I pulled it up. So I remember we were discussing back when Canopy was up here, not sure if we get the mouse up here or not, but it's okay. We were talking about how there's a couple of supports in terms of the 200-day moving average.
Right.
And so that's sort of where we landed. Remember that little bet we had in terms of 100 versus 40? I mean, it didn't quite hit 40.
If you're going to rub that in.
Yeah.
So you haven't won yet, and I haven't lost yet.
I guess
Is that
not.
what you're saying? But it came close.
But it came close, and I mean, for me, that's good enough at this point. But look, let's really discuss big picture what happened. There was a lot of excitement from this Constellation deal. A lot of people bought in, you know, with this run-up, and a lot of them now are holding positions that are underwater.
Right.
And so this big downdraft with a sell the news event, like we discussed on our last program, there was also a lot of negative news that came out at the same time. So you had Scheer, the conservative leader, talk about maybe rolling back or regulating a lot of cannabis-related things there.
Now your mouse should show up there. Let's see if that works.
Wonderful. Yeah, headline risk. The OCS was not really efficient with their rollout.
I still don't have my marijuana.
Wow, what order number were you?
I was actually order number 36,000 and some odd, I think it was.
Got it.
And I ordered
that's like the morning of, right? Or overnight, yeah.
It was midday. So I ordered two different packages of pre-rolls, which were supposedly coming from Aurora, and then one jar of the super premium Edison brand from Organigram, which also hasn't arrived. So I haven't had any conversation with them. So I wonder how this is going to impact the balance sheets of these companies going forward.
Yeah, I mean, the income statement, the revenue is going to be really important. And for me, a big surprise was the fact that there's a private producer called Redican. I was not even all that familiar with them. But guys like that, they're going to take market share from these big LPs. In BC, you only have one store, and I've heard, you know, from people that live there, they're all going to the black market. So, you know, revenues may be really impacted, and I think that's what you're kind of seeing here. But another thing, just before we continue talking about the cannabis stocks, we have to talk about the global macroeconomic backdrop.
Right.
So this is just a chart of Fed funds rate. So the market decline that we've been having since around October 3rd, it was all triggered by this.
Okay.
So something we have to understand is the cannabis companies, they're extremely high growth. A lot of their revenue, a lot of their cash flows are way in the future. It's a big opportunity. But the problem is, as rates rise, your discount rate on your investment rises as well. And so the market had an expectation that the Fed would probably stop around 2.5% to 3%. Right now they're at 2%, the Fed funds rate.
Right.
And so Jerome Powell came out, the current guy that decides this, came out with a quote where he said, interest rates are still accommodative, but we're gradually moving to a place where they'll be neutral. We may go past neutral, he said. So we may go higher than 3%. And so
we may go inflationary.
Well, that's the problem is there's not that much inflation going right now. And so this would actually be very restrictive instead of accommodative. And so what that means is this is the 10-year, and on the right you have a chart here where he made that announcement.
Right.
And that spooked markets because to have this kind of move in fixed income is very significant.
Actually, I'm just going to point out to you, just for your own sake, that the cursor on that you see here is not the cursor that you see up there.
Got it.
So it's actually not good to use the cursor.
So let me I'm watching up here.
Right.
But anyway, so where you see the blue arrow right there, it's a shorter data chart.
Okay.
It's like a 1 month chart. And so you see that big run up there in the yield. And so this is just people in the market saying, oh wow, he might actually do it, because the expectation was he wouldn't. And so what that meant for high-flying, high-growth technology, wheat stocks, it's pretty negative. But it didn't really catch up to the wheat space until after October 17th. So going back here, this is why we saw such a big sell the news event, and why I was even surprised at how quickly we dumped. As you know, I had a bunch of puts that I've been building up. I had added many more right before legalization, and I covered probably where you see this purple line. So okay. Right as it got there to, yeah, I gotta look up here. Anyway, right as we got to that purple line, which is the 100-day moving average,
right.
I covered them because I said, wow, this is a big move. We might actually bounce back up, but because the markets were in such doldrums, it actually just flatlined, and then you had another big sell-off after, where you saw moves of 15 to 20% on a lot of these names. Mm-hmm. And that was really damaging to investor confidence, I think, longer term.
Sure. But do you think the bounce back is, we're looking at it and it seems to be resolving towards the upside, or is it still a little bit soft for you?
I think it's soft, and I think today, this chart is up to this morning, right? So today we had, U.S. equity markets kind of roll over as well. I know you've been very busy today, but on the back of Apple earnings, and so you might, have a retest where it actually tests that 200-day moving average again, potentially. Who knows? But at the same time, everyone's been also waiting for a bounce, right? Like I got in a bunch of positions, other traders got in on a bunch of positions for Canopy and others, and they're sort of waiting to unload. They're waiting for that big bounce. And if you look historically, you've had much bigger bounces previously when it came to huge sell-offs. So if you looked at January, February 2018, you had one-day sell-off, huge rebound. Later on, 2-3 days of sell-off, you almost got that full move coming back.
Right.
So you're not seeing the same thing, which is very worrying, I think. And for a lot of people that bought way up there at the tops, and as the excitement kind of dies down and reality sets in, that might cause a bit of consolidation.
So are you saying you might yet collect on your $40 weed bet?
Yeah, I don't know what we're betting, but I guess I might.
Just a gentleman's bet. Okay, interesting.
Yeah.
So what's the play here? How do you deploy capital and protect it at the same time in such an uncertain market?
Yeah. So I think I covered my puts, so made good money there. But right now the option premium is very high. The implied volatility is very high. So in most cases, unless you're very certain about a direction, I wouldn't play options. I would just have very tight stops, so have a game plan for your trades. You buy something, if it doesn't go your way, you cut your loss ASAP, because as we know, things can sink a lot faster than we expect. But generally, I think the next move we have now is towards the US. So, I'm looking at names like Charlotte's Web, Ianthus, Green Thumbs, and other guys. And I'm sure many investors are too, because they're, you'll have a state legalizing recreationally every 6 to 12 months, and that's interesting. That builds excitement. You have Michigan voting, on November 6th, I believe, for recreational cannabis there. No one's really positioned there, but new markets are opening up in a very large market that is the U.S. And I think something else that starts happening now is a lot of these names start trading on valuations more so, or at the very least, you start seeing divergence in terms of certain names. So I put together a really rough, little comparables table. It's very simple. I quickly went on CDAR before my shower after my workout this morning and pulled the fully diluted numbers, kind of made some estimates for Canopy with their Constellation deal.
Right.
But this is what I came up with. So in essence, I have a market cap just based on the closing prices.
Yeah.
I have current capacity. Obviously for Canopy, they don't report, so I just eyeballed it. And according to CDAR, their most recent MD&As, this is the current capacity for all these producers.
So this is all in thousands, I guess.
Yeah, so thousands. So obviously no units here, but the current capacity in thousands, and then capacity in 2019. And so if you look at it, if you multiply by their capacity for 2019 by $5, just an up there sort of number, these are the revenues you get. And so if you take their enterprise value, which in Canopy's case, I subtracted 10 billion from their enterprise value, and divided by sales, that's the multiple you get. So the higher the multiple, the more richly valued a company is. The lower the multiple, the more conservatively valued it is. So what you see is, Canopy's at 5, Afria is a little lower, it's at 3.1, Aurora is at 12.4, HEXO's at 2.1, CannTrust 1.8, and Organigram is 1.4.
So by this metric, the bargain is obviously Organigram, and the dramatically overvalued stock, most overvalued in this universe, is Aurora.
Right, and the question, the pushback against what I'm saying now is, Aurora has a bunch of capacity they're going to have in 2020, and Aurora Sun, and et cetera, et cetera. I don't think it's actually going to be needed. I think there's going to be way more capacity just in these 6 names, to be honest with you, with black market, with home grow, with private enterprises that are also doing this, or the ones that aren't listed, the other 100-something LPs. It won't actually be needed. So that's my view, at least. And at the same time, a multiple, we're just comparing, very rough numbers here. So maybe some of these guys can have better EBITDA margins, for example. Maybe, Organigram, because they have their indoor, multi-story thing, production, they'll be able to get higher EBITDA margins because they have a lower cost, for example. HEXO, they have a Molson deal. So maybe that's worth something, right? Because they'll actually have a partner to develop their beverages. CannTrust has Apotex. Canopy has $10 billion to deploy, and they have Constellation Brands. Like, Constellation Brands is really married to Canopy here.
Right.
So you have to sort of pick and choose, and that's why, I'm not too bearish on Canopy, because even though their valuation is second highest, right, their multiple is second highest, they have these partnerships and capital, which is very valuable. They'll never need to do another raise. For a lot of these other guys, we'll see.
They might run out of money.
They might run out of money, yeah.
Very interesting. Okay, so what's your, if I was to look at this, I would say, so you must be really highly interested in Organigram and CannTrust.
Yeah, so my names, personally, I'm more interested in HEXO and CannTrust. And I like Organigram, don't get me wrong. I've held them before, they're a great company. I just like the partnership possibilities with Apotex and Molson.
Right.
That's just me.
Okay.
But I still think it's a great company, not to knock it or anything like that. But at the same time, I'm looking towards the US, like I mentioned. So these would be less than half of my position, and the majority would be looking into the US. And so what are we looking at? The next catalyst we're going to have is you have quarterly earnings this month, and then 3 months from now, you're actually going to get to see rec numbers for a lot of revenues for these companies. And if you look, the reason why I put the current capacity up is because I think that's going to make a difference. So for example, CannTrust having 50,000 kilos, that's going to make a difference versus Afria, who had 34 or so.
Right. Interesting. Well, so then it's really still a case of wait and see. Yeah. Align yourself with the growing U.S. opportunity, and align yourself with the ones that are trading at least a discount relative to their peers. And
we see what happens there for sure. And on the options front, I've been writing lots of puts and calls as well. So this is why I have this chart here. So this is just Canopy, and just because it's been the most liquid stock, it's best for this illustration. But you have something called an option implied volatility. So that's the blue line you see there. Okay. So in simple terms, the higher that line is, the more expensive options are. And the lower it is, the cheaper they are.
Okay.
So as an option buyer, right, you're disadvantaged. You're really hoping for a really big move if you're buying at the tops of these levels. So that's why I'm a seller right now, because the implied volatility is a lot higher. I think you're not going to have as many big swings anymore, even to the downside. I don't think there's going to be many big swings. Maybe I'm wrong, who knows? Deals could change that, who knows, right? But I think they're going on now, you're going to have much smaller moves day to day, and so that's going to compress the volatility, and it's going to make those options worth a lot less. I'll give you an example. I was able to write a Canopy put for a $30 strike, and I got for February, and I got paid $2 for it. So what does that mean? I'm willing to buy Canopy at $30, and I'm forced to buy no matter what. And for that, contract, me being forced to buy it, I'm receiving $2 of premium. So the math on that kind of works. Okay, if I have to put up, if I write 10 contracts, it's 1,000 shares. I get $2 a share. That's that's $2,000, right? If I do that, and my margin's only about $10,000, right? Let's say for this trade, that's a 20% return in 4 months. If it never hits 30.
Right.
If it hits 30, I'm okay with buying it because they have $10 billion of cash.
Right.
And as we saw earlier, on their this very rough numbers will be updated. Their enterprise value at $20 is all cash, pretty much.
So then if you end up being forced into buy it, you're basically buying it as a value investor.
Yeah, pretty much. Because I'm getting the business for $10, or actually $8 because I got $2 of premium. And do I think Canopy's worth $8? Yeah, that between the 20 and the 30. Yeah.
Wow.
I think so.
All right, let's leave it there again, Dmitry. That was very enlightening and confusing for me as well.
I hope not. I'm trying to.
It's very simplified. I have a very unmathematical brain. Multiplication and subtraction are my strongest and weakest suits. So we'll leave it there for now. We'll come back to you. I hope you have me back again next week, and thanks for the participation.
Always happy to be here, James.